Morning guys, hope you can hear me loud and clear. This is Sighting here once again, macro analyst. Today's topic, as you can see here, we're covering the US macro, particularly about the Fed rate hikes that happened over last week, and of course something that is very close to the US economy as well is the debt ceiling, and what is the debt ceiling all about. We will share a bit on that and how the impact on the Fed rate hikes actually will have any direct impact on the US debt as a whole. So let me just begin a bit of the background here. If you guys recall, since 08, it was the global financial crisis. What happened then was that the subprime crisis where your household, essentially a household sector, US household sector essentially over leveraged, causing the economy to suffer subsequently, and also our financial sector going into trouble because of liquidity crunch. And you can see since 2008, the US outstanding credit has actually increased by about 21% to $66 trillion as of today. So what has happened here is that in fact what we was expecting to see after the global financial crisis was actually a deleveraging of the US economy. Not only did it not deleverage, in fact, it has actually picked up on this consumption of credit. So today we see US as a whole have a larger outstanding credit more than anyone else, more than anywhere else in the world as well. So, and compared to the historical past, they are at an all-time high. So why do we talk about the US debt as a to begin with? What we want to know is that what the components, the individual components, if broken down into sectors, how we see it is that there's the foreign holders, which is a small amount. You have your corporates, your household, your financial institution, as well as your government. So government have actually taken up the slacks in the credit consumption and have swelled their balance sheet to well over $19 trillion. So when we talk about government used interchangeably, we're actually talking about national debt or their public debt, which is debt that is actually incurred by the government. So besides the government, we take a look into corporate America. Corporate America, denoted in the blue color bars in the bottom table below, you see that corporate America itself has also been picking up their credit consumption. In fact, we all know what happened last year was a huge amount of corporate America actually took advantage of the low interest rate to borrow and do more share buybacks. So that's we could see corporate America's the balance sheet of corporate America actually getting more leveraged. For financial institutions, this is something that's interesting. It was at the heart of the global financial crisis in 08. So subsequently after 08, they have actually deleveraged, deleveraged quite heavily until mid 2014, whereby they re-leverage again. You can see that their credit is actually moving up. But what I want to like to point you guys to is this: in the constitute of the credit holders in 2008 and as of last year has significantly changed. In 2008, the government hold about 10 trillion of the debt in total. And you could see that the biggest holder was still the financial institution as well as the corporate Americas or the corporates as a whole. But fast forward to 2016, we see that now government has the largest debt holding among all other sectors. Why is this important for us? Because it's important for us to know that when there's a crisis, especially that happens to a default crisis that happens to either a household or corporates or institution for that matter, the government will always be able to step in and help to help to mitigate the losses. But what happens? Our question is always, what happens if a government is to default? We're not saying that it will be likely, but as the U.S. government continues to their credit consumption, we are starting to worry about whether are they able to ultimately pay back their debt, and therefore it brings us to the next topic here, which is the U.S. government debt or the public debt itself. It's currently standing at 19.9 trillion, and obviously we all know that this has been at the all-time high. So since '08, we know we all know what happened. U.S. Treasuries issued unprecedented unprecedented amount of U.S. Treasuries bills and notes and bonds, so that the Fed could buy them and actually inject liquidity into the system. So you could see the trajectory of the national debt actually ballooned after '08, which is shown on the left-hand side of the chart. And in terms of debt per GDP, on the right-hand side of the chart, it shows you everything that we need to see. It's actually more than 100% now, and it has been going up ever so higher, reaching an all-time high. So this is actually a very worrying sign. I mean, if US doesn't default, then that's fine. But I mean, US is now one of the largest, the nation itself, the government itself now one of the largest credit holder within the nation. So if we do bring our attention to the debt ceiling that happened over last week, on the 15th of March, that was the deadline that was set for this bipartisan budget act. Just to give you guys a bit of a background, the bipartisan budget act of 2015 was enacted in November 2015 by the Obama administration. Essentially what this does is it suspend the debt ceiling through 15th of March, which so happens to be last Wednesday. So as of 15th of March, what happens is that the debt ceiling will get reinstated at whatever current debt that they have. It's so estimated to be about 19.85 trillion, to be a bit more exact. So with a debt ceiling at 19.85 trillion and a constant requirement for more cash, that is a limitation to where this borrowing can be. Before I jump the gun, I'd just like to show you guys what are the debts that's going to be subjected to this limit. Essentially, besides the debt that's going to be held by the government accounts, which is your federal, states, your government trust funds, and other local governments, most of these, essentially a huge part of this, in the graph you can see actually 14.3 trillion of this is actually your US Treasuries that's issued by the US Treasury bills issued by US Treasury themselves. And we note that 14.3, among these 14.3 trillion, 5.9 trillion is actually held by foreign investors. So are we going to get worried about this? The current situation is that US Treasury has no room to borrow under the standard operating procedure. You can see on the right side of on this slides here is actually a letter stated March 8, which was written by the current Secretary of Treasury, Stephen Mnuchin, that guy's face over there in the slides as well. So he actually was proposing to the House of Congress to extend the debt ceiling. We know that this is not going to be a problem, or it's going to be lesser of a problem now that Republican has full control of the government. You know, we have a Republican Congress, we have a Republican Senate, and we have a Republican President. So it makes it much more easier for the government themselves to raise the interest rate. However, we expect to have a huge pushback from the Democratic Party, and obviously they are trying to tie in some. The Democrat is definitely for raising the debt ceiling. However, they are not going to let Republican held hostage, and it will only the highest member of the Democratic leader, which is Nancy Pelosi, has said that they will accept increase in debt budget without debt ceiling, without any other clause. So it's essentially a clean slate for the increase in debt with no other specific clause. For example, the repeal of Obamacare and things like that. So what does he mean by, in the letter, Steve Mnuchin actually mentioned about the US Treasury will take extraordinary measures, and this will allow them to continue running the government without the issuance of more US Treasuries. So what do they mean by extraordinary measures? These are just a few examples, a few of the bigger accounts of the extraordinary measures, essentially saving up to $2 to $3 billion per measure. However, they all note that come April, there will be a very huge inflow of cash, as that's the accounting year end for the US government, and they are expected to have collect their income revenue, tax revenue, and so on. So what is it now? We all know that there's going to be a deadline for this once they exhaust all their extraordinary measures. That deadline, as projected by the Congressional Budget Office, is around for 2017, which is in September or to November. However, this is just based on simple estimates, and earlier or later date is actually possible. So what will happen in this deadline if there is no if the debt ceiling is not raised? Essentially, the U.S. Treasury will run out of cash, and the government would be unable to fulfill their obligation. This would be the first time that the U.S. government would default on any form of debt obligation. The closest that we ever came to in the most recent history was the government shut down in 2013 on October, which they shut down for 16 days, and that caused a lot of turbulence within the market. However, even in the slightest case whereby there's a default, remember that we talk about the U.S. Treasury and the percentage or the total amount that was being held by major foreign holders. You could see in this chart here that the major foreign holders are Japan and China, and so on and so forth. We all know that this was a very big news. It was actually all over Bloomberg as well, that China was no longer the largest U.S. Treasury holders. This was very impactful, as China has always tried to align their economical interests together in line with the U.S. Treasuries. But now, not only are they not the biggest, they have been subtly selling off their U.S. Treasury. And another point to note from this graph is that looking back all the way back to the total number of foreign major shareholders, foreign major holders of the U.S. Treasuries, we know that 43% of the U.S. Treasury holders are actually found in Asia. That can also explain why U.S. interest has such a huge interest in Asia. So, like I mentioned, if we could look at the trend of major foreign holders of the U.S. Treasury, is actually heading downwards. On the left-hand side of the chart, you could see that the peak in foreign holding was actually in March 2016 last year at 6.3 trillion. Since then, it have come off to 5.9. Do note that if I were to pull this chart all the way back into history, the holding of U.S. Treasury have actually never reversed before. It has always been on a upward trajectory. This is the first time we're actually seeing major foreign holders of U.S. Treasury actually heading downwards. This also implies to us that some of these foreign sovereign and government are actually having little or weakening confidence in the U.S. credibility, and therefore they're chosen not to purchase as much of the U.S. Treasury. On the right-hand side of the chart, it shows us, and in another view, the net purchase of Treasury. Net purchase includes total purchase minus of sales. These are usually your Treasury rollovers after the tenor have actually reached maturity. You could see that the net purchase has already largely declined towards in the most current quarter or months. So another big thing that happened last week was the federal rate hikes. We all know that they have now raised their interest rate to 1%, which was a quarter percentage point increase from the previous one. And however, the market actually do feel that this is a dovish hike, as they reiterate, as the Federal Reserve and Janet Yellen herself reiterated that they view 2 more hikes this year. This is according to consensus, but I guess market was expecting more as inflation picks up. Like we mentioned, earlier or late last year, we felt that the Fed was actually late in raising hikes, and we actually expect them to follow through this year with all the rate hikes that they have actually proposed. So with any form of debt, we know that an increase in interest rate will increase the debt burden for the US government. And the following chart actually shows us the federal government interest expense in billions of dollars, you could see that it has also slowly been increasing since all the way back to 1988. And the only time that it actually fell was during the crisis as well as the government shutdown. Since then, we expect interest rate to reach a new high. So this is a chart courtesy from our technical analysis, which overlays the Taylor rule and Fed fund rate, and therefore, like I mentioned earlier, we believe that the Fed will continue to raise their interest rate as promised, and they will even do more if necessary, just to curb off any form of inflation. Just a brief explanation here: the Taylor rule is a formula that there's a combination of your GDP growth, your unemployment rate, uh, your GDP growth and your unemployment rate. So from the chart, you can see easily that the Fed fund rate has always followed the Taylor rule. In fact, Taylor rule was a leading uh, indicator for the Federal Reserve in determining their targeted interest rate. But this disparity there's disparity since 2010, where on the right hand side of the chart you can see that the Fed fund rate has been very late in trying to chase up to the Taylor rule. So this is another view that where we actually view that the Fed is behind their rate hike cycle, and we expect the rate hikes to be aggressive. This was another study that we did of the rate hike cycle. We feel that it's a cycle because we all know that when the Federal Reserve hike their rates, they will essentially cut their rates later on. So historically, the Fed has always raised rate when the government debt continues to increase. The last time the Fed have continuously raised the rate was in 2004. That was to curb the the overheated economical then, and we all know what happened in 2007. So throughout history, since Paul Volcker's era, we know that no chairman have actually raised the rate and keep it there. Most of them raise the rate so that they can drastically cut the rate later on. We feel that it's no different this time around. Janet Yellen chasing the curve would have to raise the rate so that he have actually more room for monetary policies maneuver later on if the economy is going to go into overheated economy. So with the table, we could see that it's quite a simple comparison. Every time they raise rate, they decrease the rate by a further amount. I mean, obviously, would denote this chart here from the orange color line. You see that since the 1980s, our Federal Reserve rate has been going down. We all know that there's no way it can go any further unless they're going to negative interest rate environment, which has been a very big hoo-ha in the past few years. So if you look at it, the latest one was an increase by 4.25% by Alan Greenspan, and later on it was cut to 0.5, cut by 500 basis point by Ben Bernanke. The whole cut lasted about 9 years. So in all, we see this as a cycle, and we expect the cycle to be the same this time round. So to conclude, I mean, the US is currently at an unprecedented debt level, unseen before, 19.9 trillion, and with an increase in the debt ceiling, we expect the borrowings to be even higher. And our point too is that the rising interest rate will cause an increased amount of pressure for in terms of the interest rate payment. However, the situation is not unique. We have been here before. High debt, increasing interest rate environment, and the past few times it has always happened. As long as the US government can continue with their fiat currency system without any opposition from other countries, they can accumulate more debt. What do we actually mean by this? I mean, we all know that it's like playing Monopoly. You are the banker as well as the player. They can continue issuing them more currencies in terms of US dollar bill just to borrow, because no one is actually stopping them, because as of today, US dollar is still the reserve currency of the world. So they know that as long as no other countries of greater economical power comes into play and reject US dollar as the de facto reserve currency, US can continue to play this game. However, what we know that, I mean, in the long run, what are these implications? People are already looking at alternative currencies. majority being your cryptocurrency such as your Bitcoin. And even China themselves have been experimenting on SDR, which is the special drawing rights issued by IMF. Special drawing rights are a group of currencies that's is a currency that's it's a basket of currencies that's being pegged and matched against. So the other implication is actually what we have always said a very long time, that the printing of money cannot last forever. We believe that at one point in time to come, there are already some conservative within the US government asking to move back to the gold standard. What does this mean? I mean, if we all live through, we all know that Richard Nixon was the president that lifted US off the gold standard. As of today, without being a gold standard, the US dollar bill in every single American wallet is actually just a promise from the government to pay. If they were to move back to the gold standard, the dollar bill would once again be a legal tender to a claim to a certain amount of gold. So with that, our call for this webinar still remains the same, which is to get ourselves exposed to gold through the GLD US dollar gold ETF on the SGX. Of course, talking about interest rate hikes and US Treasuries, we bring our attention to our Singapore markets, and Te Hong will complete the second part of this presentation.
Hi, morning guys, Te Hong here. I'll carry on with the impact on Singapore REITs of what happened last week. We saw Janet Yellen hiking rates by 25 basis points. So Singapore REITs being one of the more interest rate sensitive sectors, we will touch on what is going to go on for that sector going on from here. So actually the March rate hike was pretty much fully priced in. We saw that before last Wednesday, the rate hike. You look at the expectations in the market for the rate hike. Market was already actually pricing in 100% expectation for rate hike because along the way, Janet Yellen gave a lot of speeches. He was actually very explicit and it was pretty obvious that a rate hike was coming in March. But what we can see from the market expectations was also that you look at the bar chart that I put up, you see the blue bars over there. So these are the bars representing the expectations for the number of rate hikes in this year. And you see that majority are actually expecting 2 more rate hikes. This is actually a snapshot of the expectations before last Wednesday, just before last Wednesday. So we see that 36% expect 3 total rate hikes, and then 39 expect less than that, and only 25% expect more than 3 rate hikes in total for 2017. So as Saiting mentioned earlier on as well, we are actually in the belief that the Fed is behind the curve in terms of hiking rates. So we think that this year there will be 3 or more rate hikes. So we do believe that we belong to the 25% camp. We believe that there will be at least 3 or more rate hikes. So in such an environment where we are moving on from an easy, loose monetary policy environment to one that is gradually normalizing, you see that this kind of gradually normalizing interest rate environment is not going to be conducive for interest rate sensitive sectors like REITs, especially so when the entire sector is going through a period whereby fundamentals are not fantastic. I would say fundamentals, some of the sectors' fundamentals can be said to be improving. Like for instance, in the office sector, we do think that demand this year would actually be better than last year. But then, not just about the demand side, the supply side is very unfavorable as well, and not just for the office sector. So you have unfavorable demand and supply dynamics in the midst of a rate hike cycle, a normalizing interest rate environment. That is not going to be very conducive for REIT investments. So we use numbers to back this up. You look at the historical yield spread of the S-REITs versus the 10-year bond yield. That actually, yield spread is the amount, is the measure of the attractiveness of the sector versus if you buy a safe haven government bond. You look at that red line, that is the yield spread. Right now, we are doing very close to the green line. That green line is actually the 7-year average since post-GFC. But if you were to think of this 7-year period as the front part would be, I would say, a very accommodative environment. Interest rates are very low. So that is the first part. I think second part will be what we are facing now, and that is we are moving into a gradually normalizing interest rate environment. So I would say if you look at this 7 years as a whole, we are actually, it's the first part, second part. The second part is actually the tougher part, which is now. So if you are facing a tougher environment now across the period, I would say your yield spread deserves to be at least close to the green line or above the green line. If you look at the red line, the yield spread, so starting from after 2015 second half, it's actually been trading above the green line, which means that the yield spread has been above the 7-year average. And actually, I think that reflects that was when the Fed started its first rate hike, and I think that reflects kind of the general macro environment that we are in. So given that our red line, our yield spread now is close to the average, I think this is by no means cheap. It's a fair value, or we expect the red line to be trading close to this green line or above, which means to say prices should stay around this level or lower. REIT prices. So as we move into an environment with normalizing interest rates, we think that investors should adopt a bottoms-up approach, because it's no longer going to be a rising tide lifts all boats scenario where you have low interest rates, very conducive for REITs, everything goes up, even your lousier, not as good REITs also go up. It's going to be more challenging now. So you're going to have to be more selective. And we favor REITs with lower gearing, such as Mapletree Industrial, or supported by favorable macro and economic conditions, such as First REIT, you're in Indonesia healthcare where demand is growing, or those that have favorable long leases, such as Croatia's. So we have accumulated ratings on these 3 REITs. And this is a table for your easy viewing. There's a color scale there for your easy reference. So the hike in the interest rate is going to impact firstly those people who are more highly geared. Secondly, if you have less debt which are on fixed rates, your floating rate, your debt on floating rates will be impacted as well. So you look at those. You look at the color scale. Green will be more favorable, and if it moves towards the red color, that would mean that it's actually not very favorable. Like for instance, if you look at the column for percentage of debt on fixed rates, red means it's a lower amount of fixed rates, which means that the impact on you from rising interest rates is going to be higher. And likewise for the gearing column as well, red means higher gearing. Okay, so we continue to advocate a switch from REITs to developers. We have made a few initiations on developers late last year. We had one on CDL, that was when prices were close to 8+. Until now, it's done a close to 20% rally. We had UOL as well, close to a 10% rally. We had Centurion as well. And then year to date, you see that the performance for S-REITs actually lagged far behind developers as well. REITs went up. The REIT index, you can see, is up about close to 4%, but developers index is up about maybe close to 20%. So right now, from here, where do we go? The strong performance of developers actually has narrowed the kind of upside versus our target price, we still have two counters which still presents pretty favorable upside. We still have Ruby Land with a 14% upside and UOL on a 4% upside. These are for people who are switching out of REITs but still looking at property related alternatives. You can consider this too. As for people switching out of REITs but you are looking at more of like a dividend yield kind of counters, we have under our coverage these high dividend yield counters as well, which also provide some form of upside to our target price. We have ranked by market cap. We have ComfortDelGro, Sheng Siong Group, Old Chang Kee, and Namdi Press Metals. These are stocks which have close to 4% at least dividend yield, and upside to target price is at least a 10% as well. So these are the alternatives that you can consider if you switch out of REITs. So with that, we've come to the end of our presentation and we welcome questions.
Hi guys, as you guys ponder on the question to us, may I bring your attention back to the survey, the link is actually clicked in the chat box. So you guys can actually go there, click on the link and help us do a survey on the content as well as the presentation for the day. Thank you. Hi, we have replaced the link for those that was late in joining.
Hi, morning guys, Teo Hong here again. We have a question on Croatia's. So we look at this table and I said before that higher gearing means is going to be more negatively impacted by rise in interest rates. So the question is that Croatia has a gearing as high as 46%. You see that is the most red bar, right? It's the most red bar in that column. It's the highest gearing. Why are we still calling for accumulate? So it's a very good question. We have to consider the environment and the kind of country that the REIT is in as well. As we know, Japan is having very, very loose monetary policy still, and also moving into negative interest rates. So Croatia's being in Japan Oh, first thing, they're not a REIT, so they're not subject to the 45% gearing limit, they're business trust. And then, so since they're in Japan and interest rates there are actually falling, it's very accommodative still over there. So like this year, they're gonna see substantial savings from the refinance debt as well. We touched on that in our reports as well. So for Croatia, I think the high gearing is not a problem because they are in a country where the macro monetary policies are still very accommodative. So that actually should allay some of your fears for investors who are worried about Croatia's high gearing.
There's a question on the possible takeaway for the U.S. macro analysis earlier. Like we mentioned, the U.S. Treasuries is at an all-time high. The U.S. debt, national debt is at an all-time high. Whether it will be sustainable, we have seen historically they have done so, but we do feel that this time around we see a lot of value in gold, um, especially in a fiat monetary system. Therefore, we are actually pushing for or recommending gold holding at this point of time until there's a further change in the macro outlook. There's another question for the potential increase in the Fed rate hikes. Hence, the US dollar would strengthen, therefore negative for gold. If you have seen last week's market reaction, you know that there's actually very little correlation in that sense. Even when we did our historical study, we know that there is no direct correlation between an interest rate hikes and um, US dollar strengthening with the gold actually weakening. This is actually not true. The correlation, although it's there, but well, we know that the correlation at times is broken, and we see gold moving up higher. Obviously, we know um, the goal is not just driven by US dollar, although it's being denoted in the US dollar, it gets affected by the US dollar strength, but um, gold itself has its own demand and supply um, market, and from our perspective, from a fundamental perspective, we know that gold tends to is moving up in a upward direction with a higher demand in the current market.
Hi guys, Hong here again. Another question on the developers front. So our client is asking that is the reflation in the valuation of developers' stock price overdone, as it is still expected that prices of the physical property market is still expected to fall this year. So we touched on this previously in our report, and we are of the opinion that for developers, it is important that you need to be able to do capital recycling. So your stock prices will be a function of prices and will be a function of volume as well, transaction volumes. So right now what we are seeing on the ground is that despite the prices still falling slightly, but with the changing of the track in the government's stance on the cooling measures, like we saw 2 weeks ago, they actually reversed one of the cooling measure. So with this, it's likely that sentiment will continue to be supported. And then you see a lot of recent launches on the ground as well. You see the response is just enthusiastic and it's just very, very positive. The kind of selling volume that the developers are able to achieve. So with this slight drop in prices, our view is that the margins for developers are still healthy, and you're able to recycle capital. That will actually be a very good catalyst for your stock price. And you look at the discount to books of some of the developers we have. You look at Hobby, discount is still 45%. UL as well, discount is still 30%. So despite the rally, even though technically there may be a bit of exuberance in the very short term, but then in the long term, we have a 1 year target price. We still think that there is still room for upside on a 1 year horizon basis.
Okay, hello. We have a question about how is the Ezra shares impacted? The extra bankruptcy proceedings will impact the banks. So this morning, the banks have come forward to issue some statement. And as for DBS, they have already made suitable provisions for Ezra in third quarter. So they have already put them into MPLs and provided for those MPLs. And as for the on UOB Kayhian has no sorry UOB has also come forward to say that actually they don't have any this I mean the provisions are actually um, uh, manageable, right? So all this is actually in control. So there's we don't expect any issues moving ahead for this for the banks. Thanks.
Hi guys, I think we have in our timing. There's no other question. We'll end our presentation here. Thank you for your time. Do tune in again next week.